high level, there's really only three ways to become financially independent. The first is we win the lottery, we sell a company. Very few of us are going to do that. The second is we save money every year, and eventually we have enough money that we're financially independent. That's how most of us will do it. But some of us will build up passive income streams. And eventually those passive income streams will exceed what our living expenses are. And at that point, we may be financially independent. And that's what I want to talk about. The third one, building up passive income streams. And I want to differentiate between passive income streams and recurring revenues. Recurring revenues might be, somebody writes a book and the money's coming in every month from that. The challenge with recurring revenue streams is a lot of those recurring revenue streams really mean recurring work. And so I'm really focusing on the things that are truly passive, that they don't require a lot of your time. And the first one I want to talk about is building a portfolio of dividend-paying stocks. This is personally my favorite way to do it, which is you invest in companies that are paying cash flows to its investors. It's not easy to do. You have to be super careful. You have to be much more interested in the return of your money, your original investment, than you are in the return on your money, what percent the dividends are paying you. But if you can choose a portfolio of solid companies that have solid operating histories, strong management systems, they're conservatively financed, and they're sharing some of their operating cash flows. So they have good businesses, profitable businesses, and they don't need all of the capital that's generated by the company in order to fund their new opportunities, in order to keep the company running well. So that's my favorite. Again, you have to be super careful. You have to follow the rule of being more concerned with the return of your money than the return on your money. So focusing on how strong of a company is this. And for most of us, what that means is probably having a professional build that portfolio, because what you do not want is a company borrowing money in order to pay out dividends, because that game doesn't last forever. Eventually, the investors, everybody get hurt. And you also don't want a company that used to be a solid company, but is going downhill quickly. And they have excess cash flows from past successes, but those past successes are only going to last for so long. So that's the first one. The next one is not 100% passive, but it tends to be one that a lot of people have in the past been successful of. It doesn't mean you'll be successful in the future, but that is building up a portfolio of rental properties. You have to be careful, how much you're paying. You have to be careful that you can comfortably make the rental payment. You have to do a what-if scenario analysis. What happens if your unit is empty, it's not rented out for 6 months, a year, or longer? But I've seen people do well in this in the past if they're conservative. It's interesting when you look at attorneys that specialize in real estate, they tend to have two areas of expertise. One is real estate, but you know what the other one is? The other is bankruptcy law, because when people overextend themselves in real estate, and the way you overextend yourself is by taking on too much debt, and then something unexpected happens and you can't make those debt payments. And that's when the time comes to pay the piper, which is important. I want to bring this up at the end of this video. Towards the end, the last thing I'm going to talk about is asset protection, which is, that's a good defense. We're talking about a good offense here, generating the income. But if you don't have a good defense, it can all be taken away from you. So that's the second way, is building a portfolio over time, conservatively, wisely, of rental properties. And then the third way is similar to the dividend stock portfolios, but instead of being on the equity side, more on the debt side. And those are having a portfolio of high credit quality bonds. Again, you're concerned about the return of your money. And then high yield FDIC insured savings accounts. So I personally favor having security and having confidence that I'm not going to lose the money that I invested. So what that means for me is high quality bonds. It means shorter duration bonds that are going to mature in 1, 2, 3, 4, maybe 5 years. So I'm not out 30 years if interest rates rise. I'm going to be sad that I own a 30-year bond. So be careful with how long the bond is. There were plenty of people after the pandemic started when the 30-year treasury for the first time dropped below 1%. Inflation was zero, inflation was negative. They wanted security, and they locked up their money for 30 years for a very, very low interest payment. And when interest rates rose, they got hurt, even if it was a bond issued by the U.S. government. Yes, you're going to get your money back, but over those 30 years, you're going to get a lower return on your money. So those are the three passive income. But again, that's the offense. What about the defense? How do we protect our assets? And for that, I want to turn to a Fidelity article. It's called 5 Steps to Help Protect Your Assets from the Unexpected. I want to start off. I'm not an attorney. I'm not an accountant. These are things that I think should be on your radar screen. And you should talk to an attorney. You should talk to a tax accountant on these. Okay, so the Fidelity article says the first thing to do to protect your assets is to assess your exposure. Do you have liability? Are you in an occupation that people occasionally get sued? Do you own assets like rental properties that we talked about earlier, where somebody could slip and fall and sue you? The second step is find the right type of insurance. Get insurance to protect you from that exposure, or at least consider that. The next step is consider establishing a limited liability company or a limited partnership, because if everything's titled in your name and somebody slips and falls in a rental property, again, I'm not an attorney, but my understanding is people can come after you personally, which means your personal assets, your personal savings account, your personal bank account. And that's a situation that you want to protect yourself from if you can. And one way to do that, again, talk to an attorney, is a limited liability company or a partnership, a C corporation, something like that. Okay, number 4 is explore trust solutions to protect inheritances. Let me read you what Fidelity wrote. Living revocable trusts do not provide protection against creditors, says somebody that they interviewed. But parents can set up irrevocable trusts for their children as part of their inheritance plan. This may, and the key word is may, this may offer protection from their children's future creditors and could, keyword being could, shield the assets from being divided in the event the children get a divorce. Number 5, and stick around because I've got number 6, which is my bonus. Number 5 is to understand the trade-offs. The article says many asset protection strategies can significantly reduce the control and flexibility that owners can exert over their assets. Depending on your circumstances, you may find that the benefit of protecting your wealth outweighs the drawback of giving up some control over it. Before taking action, individuals should carefully weigh their options with their attorney and their tax advisor before placing assets in irrevocable trusts, LLCs, limited partnerships, or any other structure. I second that. Definitely talk to an attorney, talk to an accountant. And then the article goes on to say, that said, it's important to have your protection plan in place well before you incur any liability. If somebody's tripped and fallen in a rental property and it's already in your name, it's not in an LLC, it's too late. I talked to an attorney, but in general, it's too late to set up an LLC at that point to protect yourself from that liability. Okay, so what's my bonus? My bonus is, yes, let's use the rental property. Yes, you can set that up in an LLC, and that should give you some additional protection if somebody trips and falls at the rental property. But what if somebody is suing you personally and you're the sole owner of that LLC? Could they attach and say, hey, Azul owns this LLC that owns the rental property? So I call it looking both ways. Your rental property inside an LLC protects that liability that happens on the rental property from attaching to you personally, or it offers additional protection. But what about the reverse? What about if somebody sues me personally? Could they get my rental property? And they might be able to. The term that you want to look for, charging order. So you want to do a search on charging order, and does it protect you from a charging order? Again, not financial advice, not legal advice. Something to put on your radar screen for you to look up yourself. If you enjoyed this video, the YouTube algorithm says this is the next video of mine that you should watch specifically for you. Thanks for watching this one. Bye-bye.